bullish rotation play towards the Dow Jones Industrial Average and the small cap Russell 2000 has taken shape in the US session overnight, where the Dow Jones Industrial Average and the small cap Russell 2000 outperformed against the heavily weighted technology-centric Nasdaq 100 and as well as the S&P 500 due to a negative news flow surrounding Microsoft. The US dollar continues to decline for the fourth consecutive session, led by the euro, the sterling, that managed to rose to a 7-week and as well as a 5-week high against the dollar. And most importantly, the Asia Pacific stock indices continues to bask in the bullish limelight, except for the Hang Seng Index. Good morning. Welcome back to your daily dose of market insights. I'm Kelvin here, your senior market analyst from OANDA. So before we kickstart today's gist of the daily dose, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so as usual, before we jump into the intraday technical outlook chart of the, we call it broad-based cross-asset classes that we cover on a daily basis, let's have a recap what has taken shape yesterday in terms of the news flow, economic data release, and as well as their respective impact on the broad-based cross-asset classes. So yesterday is a key data release day wide for the US session because of the ISM services PMI data and as well as the ADP privately compiled we call it a labor market data. So let me share with you from the data point of view, first. Right, so just to make sure that my screen is up. Okay, good. All right, so prior to the release of this important ISM services PMI data, we do have this tier 2 ADP employment change data. So it's a privately compiled data that has a, put it with that, the mechanics of how they calculate employment change is different from the officially labor bureau statistics for the US on their much more important non-farm payroll data. But despite the fact that we know that the US government was shut down around a month ago and market participants much more rely on this privately organization compiled data. So the ADP employment data came in worse than expected because market consensus is expecting a positive 10K gain for the month of November, but it came in at a negative 32K gain. So that actually further cement this up and coming third interest rate cut by the US Federal Reserve on next week, which is 10th of December. So if you look at the CME Fed Watch 2, the odds that is being priced in by the Fed funds futures traders continues to be on the very high side, which is more than 80%. All right, so let me share with you the latest chance or the latest odds. So it's coming at 89%. So almost coming very close to 90%. That we will have, seems to me that it's a near certainty that the Fed is likely to cut interest rates by another 25 basis points. So that will be the third cut for this year to bring it down to 3.5% to 3.75%, right, from the current rate of 3.75 to 4%. And what's interesting, if you look at the aggregated tab over here, where we start to see the forward-looking probability of the potential interest rate cut, pause, or hike in the next meeting in 2026. So that is also being priced in as well by the Fed funds futures market traders, using those longer, the next few months of expiry date, not the current month. That means, you know, futures market, it has various expiry date that is trading simultaneously. So based on whatever price action and the current, in conjunction with current related news flow and economic data release, so the Fed funds futures traders continues to price in at least 3 interest rate cut for next year in 2026. So 59%, 60% chance that the next cut will come in on the 18th of March, and a rather higher chance of 87% may come in on the 29th of April next year. All right, so put it away that this will be the next cut, or the fourth cut will come in either March or April. Then thereafter, the fifth cut will potentially come in on the 29th of July 2026 FOMC meeting at a rather high chance of 79%, and also not really that high right now, but still above 50 the 6 cut potentially at 57% chance right now may come in on the last meeting of 2026. That will be the 9th of December 2026. So at the end of the day, the Fed Funds futures traders right now, based on the latest relevant economic data release and news flow, are pricing in a minimum of 3 interest rate cuts to come in next year to bring down the Fed Funds rate to 2.75% to 3%. So that is a rather dovish, we call it behavior by the Fed Funds futures traders, and that also allowed the US dollar to continue its slide yesterday. So still bear in mind that for those who follow my daily dose, why the dollar is at the critical juncture by looking at the US dollar index. So what you could see is that previously we have 3 consecutive bearish candlestick of spinning top forming on the 20th of November to 24th of November, right exactly below a key medium-term pivotal resistance, which is the upper limit of this complex sideways range configuration that has taken shape since the low of 1st of July at 100.54. So I did mention that once there's this bearish reversal or bearish reaction candlestick that was formed on 25th of November, do take a close watch on. And on the 26th of November, why? Because on the 26th of November, finally it managed to close back down below 2 key moving averages, which is the orange one, the 200-day moving average, and as well as the 20-day moving average. So indicating that the earlier push up above the 200-day moving average is a failure bullish breakup, and price action continues to trade down below the 200-day moving average and the 20-day moving average since 26th of November. And most importantly, yesterday, I do mention that once it breaks down below the first support level of 99.25, there could be a big risk that there is potentially further weakness to slide down towards the middle part of this complex sideways range configuration, where the lower limit will be at 99.55 over here. So the middle part of the range will be at 98.67, which is the next support level to watch out for, followed by 98.03. So net overall, the technical elements of the US dollar index continues to remain weak. All right, ahead of the key risk event for this month will be the FOMC meeting on the 10th of December. All right, now back towards the US stock indices right now. So the performance of the US stock indices, all 4 of them closed in the green yesterday. So like I did mention over here is that occasionally there will be some rotation play taking shape. So yesterday was a bullish rotation play into the laggards, which is the Dow Jones Industrial Average that has been lagging behind year to date to the high-flying Nasdaq 100 driven by the AI optimism play. So the Dow Jones Industrial Average managed to inch up higher to 0.9% yesterday, and the Russell 2000 up 1.91%. So despite the lackluster performance of the Nasdaq and the S&P 500, all of them are still remaining above our key short-term pivotal support level that I mentioned in my daily dose yesterday. So later we'll touch more about that when I cover the second segment. So what's interesting, what causes the drag or the underperformance of the Nasdaq 100 and the SPX 500 yesterday was due to this negative news flow coming out from one of the mega cap technology stocks, which is Microsoft. So let me expand my screen so that you guys can have a better view of the fonts. So Microsoft denies lowering AI sales quota after a report. So there was a report stating that it has reduced sales quota for its AI software products. So that is being viewed as a rather negative sentiment. Why? Because we know that in 3 weeks or 4 weeks ago, there was this fear about this AI bubble brewing in the US stock market. So anything that is rather sensitive to a reduction or a pessimistic outlook regarding AI driven software or products by these mega cap technology firms will potentially create a negative feedback loop. So after this report saying that the sales quota has been reduced for Microsoft AI software products, so it actually came out with a statement saying that the company actually denied such report. So earlier it actually fell to a 3% decline. So by the end of the US session, the losses were trimmed to only negative 1.6%. So if you look at the heat map of the S&P 500, we see deeply in the red, that Microsoft still managed to close down negative 2.5%. So pardon me. So this report, I believe that it fell 1.6% was not exactly at the close of the US session. So perhaps it's just only what 3/4 of the US session, where you have 1/4 of the US session left. So at the end of the US session, this is the end of the US session. Price performance, the Microsoft down negative 2.5%. So that also impacted other mega cap technology stocks like Nvidia down negative 1% and Apple negative 0.7%. Amazon down negative 0.8%, but thanks to Google, which is gained by 1.21%, that managed to allow the Nasdaq 100 to close in the green yesterday. All right, so that's cover the first segment of the daily dose. So let me now move on. Okay, before I move on to the second segment, there's one more news flow that is impacting the underperformance of the China and Hong Kong stock market. Is due to this jitters coming up from the China property market, which is very important. Why? Because the China property market in the last 4 years is causing the underperformance of the China A-share stock market as well as the Hong Kong stock market against its major developed peers, which is against the the MSCI All World Index, which is considered as a developed benchmark stock indices globally. So because of the jitters in the China property market causes this underperformance. So any particular news flow out from China major property developer will potentially cause a negative feedback loop into the China stock market and also the Hong Kong stock market. So yesterday, China Vanke. So Vanke is one of the major China property developer. So there was a negative news flow coming out from Vanke stating that it decided to extend its bond payment delay. So we know that the China major property developers is facing a cash flow problem since the pandemic took shape in 2020, and Vanke make an announcement stating that they will delay their bond payment due to some cash flow problems. So that created a spike up in a bearish bet on China Vanke stock that climbed to a decade high on the Hong Kong stock market yesterday as investors wagered on the downward spiral in the developer shares that will extend following its short bond payment delay. So with that actually have a negative macro we call it a spillover impact on the deflationary risk spiral in China. So we know that recently the deflationary risk spiral in China has been reduced. The fear has been reduced. Why? Because core CPI data has started to improve in China. But we know that if the China property market continues to have this negative sentiment, especially for major China developer, China Vanke, facing some cash flow problem, that could indirectly create this deflation risk spiral coming back into the forefront of shorter term traders. Again, why? Because we know that close to 70% of China's citizen wealth is being locked on into the China property market. That means, i.e., if China faces a problem in terms of its balance sheet, indirectly it means that the China property market will continue to tumble as well. So that has this negative feedback loop. So later I'll share with you what are the key levels to look out for on the Hong Kong 33 index, which we have in our platform that represents the Hang Seng index. So with that, let us now proceed to our second segment, which is the intraday technical outlook segment. All right, so let me expand my screen so that you guys could have a better view of the charts here. All right, good. So I think the screen is expanded. So let's start with the FX market first. All right, so starting with the euro dollar. So the euro dollar continues to inch up higher since the start of this week, where we continue to have a bullish bias. So as the price action move up higher, we will continue to adjust our key levels as well. So the first support, the second resistance level has already been met at 116.50, 116.60 before the price action inches downwards, all right, over here during the start of the Asia session. And what's interesting over here is that the RSI has really exited from the overbought level, and prior to its exit from the overbought level at the end of the US session yesterday, it traced out a bearish divergence, all right, over here after hitting our after hitting our second resistance level at 116.50, 116.60. Right, so let me adjust this level and look at the current exact swing high that is being made during the start of the US session yesterday. So right, not at the start, at the middle part of the US session, all right, over here. Okay, which is at 116.75. All right, so let me put it in writing. 1.1675. Okay, so right now what we could see now is that the RSI, due to this prior to the exit from its overbought level, by flashing out this bearish divergence, indicating that there is a risk of a much more intraday pullback taking shape over here. So intraday pullback, a key support level to look out for today will be at 116.50, 1.1615 level over here. All right. So if you look at over here, is that previously there is no handbrake in the rally after breaking out of that 50-day moving average earlier on Tuesday US session at 3 a.m. So there's no handbrake. That means one straight line. So there could be a big risk that over here the price action may fall much more quickly. So, but nevertheless, overall, the structure up move still remains bullish. Why? Because price action managed to go above the 50-day and the 20-day moving average. And how it actually moved up, it moved up from a double bottom bullish breakout formation, which I highlighted in green. From the first bottom will be at the 5th of November, second bottom that was formed on the 21st of November to 25th of November. So bear in mind that because of this bearish divergence that's been seen on the hourly time frame chart, so there will be a slightly deeper intraday pullback. So once the intraday pullback coming very close to the 116.15 level, I will still maintain that bullish bias. So as long as this pullback didn't break below 116.15 level, which is pretty key as well. Why? Because they are so confluence with the 50-day moving average, we'll still maintain a bullish bias on the euro dollar. After 116.75, the next resistance level to look out for will be 117.20, which is the 1.236 Fibo extension of this ongoing recovery taken from the low of 5th of November and 117.20, also confluence with the minor swing high of 6th of October and 17th of October. However, a bearish breakdown below 116.15 will invalidate the pullback first, bullish bias view thereafter, to see a deeper direct pullback shaping further weakness towards 115.90, maximum 115.50/115.40, which is the congestion area here of 26th of November and 28th of November. And if we do the Fibo retracement of this ongoing intraday bullish impulsive up move from the low of 21st of November all the way up to yesterday's US session high, that also constitute very closely with the golden ratio at 61.8%. Up next will be the sterling dollar over here. So the sterling dollar also burst up yesterday and finally break up above the 200-day moving average and the 50-day moving average, indicating a rather strong milestone in terms of technical analysis standpoint. Why? Because it managed to shake out the previous negative multi-week negative decline move that has taken shape since 17th of October all the way down to 6th of November, and on the 30th of October it broke down below the key 200-day moving average, so indicating that all this move over here is a failure bearish breakdown move below the 200-day moving average and giving the strong push-up move that is being seen yesterday at the 200-day moving average, indicating that the sterling dollar potentially also may start to see a much more significant recovery right now as its technical element starts to turn much more rosy towards the pound. So given the fact that the way it moves up, there's no bearish divergence that's being flashed out versus in contrast with the euro dollar. But in today's Asia session, it managed to actually exit from the overbought level after being a most extreme overbought level in the past 3 months. All right, so this is the most extreme overbought level so far that we see in the last 3 months. So what we could see now over here is that the sterling dollar may now see a pullback over here. So pullback level to watch out for in the intraday session will be at 132.96, maximum 132.70, which is the former minor swing high of 27th of November and 1st of December, which is our resistance level that we have as well yesterday, and also confluence with the 50-day moving average. So as long as this minor pullback managed to hold above 132.70, we will still have that bullish bias on the sterling dollar. That means, i.e., a pullback first before a continuation of this ongoing minor bullish impulsive upmove sequence continues to take hold. So as long as this minor pullback didn't surpass below 132.70, tighten short-term pivotal support level that I have for today on the sterling dollar, I'll still have that bullish bias bearing in mind. After 133.70, the next two resistance level to look out for will be 134.15, followed by 134.50, 1.3450, which is the 2-time Fibo extension of this ongoing minor bullish impulsive sequence that has taken shape since the low of 5th of November. And this 134.50 also confluence with the minor swing high area of 16th of October and 17th of October. Only a bearish breakdown below 132.70 will invalidate today's bullish bias view on the sterling dollar to see a deeper minor corrective pullback to reintegrate back down towards the rising 20-day moving average, acting as the next near-term support level at 131.80, maximum 131.40 next. So that will be the sterling dollar. Next up will be the Aussie dollar. So the Aussie dollar continues to squeeze up as well over here, and is now fast approaching has already almost made our second resistance level at 6620/6630, which is the minor swing high area of 29th of October. And this is very important level. Why? Because if you were to look back on the daily time frame chart over here, this 6630 confluence with this long-term circular descending trend line that has been in place since 25th of February 2021 high. All right, over here, all right, this pink line over here. If we go all the way back in the last 5 years, is of this 5 year, this 21st of 2021, 24th of February swing high. So previously, all the bullish move managed to cap by this long-term circular descending trend line that's been in place since 25th of February 2021 high. So there's a multi-year higher. All right, so now confluencing at 6630 as well. All right, over here, so there could be some form of a minor pullback taking shape, given the fact that the hourly RSI has also hit a overbought level as well, and now has exited from the overbought level. But prior to hitting the overbought level, there is no bearish divergence. All right, there's no bearish divergence. So with that, we'll still maintain that we do not want to fade the move, because given the fact that there's no bearish divergence, so we will use any form of a pullback to actually look for lower levels to remain into a bullish bias dynamic potentially. So first pullback support level to watch out for will be the minor swing high of 13th of November. Yesterday, it managed to test during the US session and stage this last push up seen during the Asia session at 65.80. So maximum will be 65.55 over here, which is the minor swing low of 3rd of December that also confluenced with the minor swing low of the 2nd of December during the US session taking shape. So as long as this minor pullback didn't surpass below a tightened adjusted upward pivotal support level at 65.55, we'll still maintain that ongoing bullish bias after this minor pullback has taken shape. Next resistance level to look out for will be 66.60, which is the minor congestion area of 16th of September and 17th of September. However, a bearish breakdown below 65.55 will invalidate today's bullish bias view to see a deeper minor corrective pullback towards 65.37 and 65.20/65 figure level. Also coincide closely with the 50-day and the 20-day moving average, acting as a similar support area level as well to these graphical support levels. All right, so that will be the Aussie dollar. Next up will be the dollar yen over here. So the dollar yen managed to slide down as expected below our pivotal resistance zone that we highlighted yesterday at 155.95/156.18, which is the excess. So given the fact that the dollar yen now has started to bounce up from the oversold level over here, so there could be a potential retest back again at the 155.95 level, 156.18 level. So I'll be still using this level here to maintain my bearish bias view, given the negative rejection of it yesterday. All right. Oh no, rejection of it on the Wednesday, Tuesday US session, and Wednesday Asia session throughout the European session, and only the bounce has started to take shape after the end of the US session and in today's Asia session as well. So right now it's fast approaching the 20-day moving average that is acting as an intermediate, has really approached the 20-day moving average, acting as an intermediate resistance level at the 155.50 level. So maximum allowable for this squeeze up will be at my pivotal resistance zone here at 155.95/156.18. So I'll still maintain that bearish bias as long as 156.18, the excess, didn't surpass the upside. Near-term support level to watch out for will be the first support level at 154.85, which is the minor swing low of 1st of December. A breakdown below it may expose the next near-term support level at 154.40. Only a breakout above 156.18 that would invalidate today's bearish bias view to see a squeeze up towards 156.60, maximum 157.15. So that's for the dollar yen, and also sum up the intraday technical outlook on the 4 major US dollar pair. So now let us now proceed to the major stock indices, starting with the Hong Kong 33 over here. So the Hong Kong 33, what you see over here is that it did a slide, over here a slide. And what we could see over here is that yesterday, this was my pivotal support level, now turns into like a resistance level. And what's interesting over here is that we start to form another bullish divergence taking shape. So yesterday fall was due to that news flow from that China major property developer Vanke missing up proposing to delay its bond repayment, and that causes market participants to have historical increase in bearish position on China Vanke stock that causes the sell off in the Hong Kong 33 yesterday. So right now elements are rather mixed. So what I could see now is there's a bullish divergence that's been formed on the hourly RSI, and price action now try to fight back to close above to have a hourly close back above 25,840. So that was my previous short-term pivotal support level that I have yesterday. So with that fact over here coming to play for today, I will have a neutrality stance for now first, right, on this Hong Kong 33 index over here. Okay, let's put it into a neutrality range. Okay, so neutral between 25,840 and 25,410. So neutral between this. So if we have an hourly close back up above 25,840, then yesterday's bearish movement will be negated to see a potential recovery back towards 26,010, our first next recent level to watch, followed by the important 26,275/26,310 that prices has been kept below it since 18th of November this year. All right, so that's for the Hong Kong 33, flipping to a neutrality stance at this point in time due to a bullish divergence that's being seen on the hourly RSI, having a lack of conviction for a bearish move despite yesterday's breakdown of the 25,840 short-term pivotal support level. Next up will be the Japan 225. So the Japan 225 rallied as expected and cleared above the 20-day moving average that has been acting as an intermediate resistance since 14th of November. So now it's fast approaching our upper limit of our first resistance level at 50,730. So that being said, the RSI is now at the overbought level, no bearish divergence yet. So potentially there could be a minor pullback. So as long as this first minor pullback level to watch out for will be yesterday's Asia session high, now turns into a pullback. Let me remove this. Remove this dotted line here. It now turns into first pullback intermediate support level to watch out for. That will be at 50,150. Maximum 49,710. My adjusted short-term pivotal support upwards. So as long as this minor pullback didn't surpass below our adjusted short-term pivotal support at 49,710, we also converge very closely with the 20-day moving average in red over here. We'll still maintain that bullish bias view for the Japan 225. Above 50,730 potentially exposes us the next intermediate resistance level at 51,530, defined by the minor swing high of 4th of November, 11th of November, as well as 13th of November. Only a bearish breakdown below 49,710 would negate today's bullish bias view on the Japan 225 to see a further slide to retest yesterday's short-term pivotal support level at 49,085, which is the minor swing low area of 1st of December, and now confluencing exactly closely with the rising 50-day moving average as well. So that's for the Japan 225. Next up will be the Germany 30, representing the German DAX. So German 30 continues to bounce yesterday from our first support level after a test of it during the US session, which is the 20-day moving average at 23,670. So it hasn't cleared above our first resistance zone, which is the 23,885/23,960, which is very important. But that's also confluence with the 50-day moving average as well, where price action has remains below it since 14th of November. So no change in terms of the key pivotal support level, unless we have an hourly close during the European session above 23,960, then I will tighten my short-term pivotal support level to 23,670, which confluence with the 20-day moving average, and as well as the lower limit of this ongoing minor ascending channel drawn from the low of 21st of November. So still maintaining that bullish bias above 23,960, potentially sees the next intermediate resistance coming in for the Germany 30 at 24,140. which is the minor swing high of 14th of November. However, a bearish breakdown below 23,480 will invalidate today's bullish bias view to see a deeper slide towards 23,370, maximum 23,150. Up next will be the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 yesterday surpassed our first resistance level and now hitting our second resistance level at 48,000 figure level. And also the RSI now has already started to exit from the overbought level. So potentially there could be a minor pullback taking shape during the start of the US session, minor pullback support level to watch, or even before the start of the US session during the European session at 47,750. Maximum 47,560. That will be my Titan short-term pivotal support level that I have for today, which is also the minor swing high area formed during the start of the US session, where it formed a bullish reversal hammer candlestick. And right now, this 47,560 level confluence with the lower limit of this minor ascending channel support drawn from the low of 24th of November. So using an adjusted Titan short-term pivotal support level to maintain my bullish bias, 47,560 in any form of a minor pullback that may take shape thereafter during the European session due to the exit of its hourly RSI from the overbought level. After that, potentially there could be another bullish upleg above 48,000 intermediate resistance level exposes up towards the current all-time high at 48,450. And very interestingly, this current all-time high also confluences with this ongoing dynamic bullish ascending channel drawn from the low of 24th of November, and also a key Fibo extension level taken from the low of 21st of November, push it up to the high of last Friday high and put it down to Tuesday Asia session low, that is 0.618%. 0.618 Fibo extension, no percent, pardon me. However, a bearish breakdown below 47,560 will negate today's bullish bias view to see a deeper corrective move towards 47,180 again. So that was yesterday's pivotal support area, which is also confluence with the 20-day moving average. Only a breakdown below 47,180 may see a deeper corrective pullback towards 46,810 / 46,575, which confluence with the rising 20-day moving average. So that's for the US Wall Street 30, representing the Dow Jones Industrial Average, still maintaining that bullish bias after a minor pullback that may take shape, holding above 46,560 short-term Titan pivotal support. Next up will be the S&P 500. So the S&P 500 yesterday almost hit our first resistance level at 6,880 before trading sideways. So given that it hasn't cleared above 6,880, I will still have my I mean, I do not want to tighten my pivotal support level to be so tight, so I adjusted it slightly upwards for today at this 6,800 level, which confluenced with yesterday's intraday low at 6,809 during the start of the US session, and also this dotted gray line here. So this dotted gray line is very important. Why? Because on Tuesday, it managed to survive and stage a bounce, and yesterday it came close to it and staged a rebound as well. So why this dotted line is important? Because this dotted line is a line that previously kept the boost in check since 12th of November, and this line also has taken shape at the start of a fresh all-time high that was being printed on 30th of October, and it has recently surpassed it and retested it on 2nd of December and close to it again on 3rd of December and even during the 2nd of December US session as well. So 6,800 very clear is a key sentiment level, so that we might adjusted pivotal support level today for the SPX 500. So maintain that bullish bias. Two resistance level to watch out for: 6,880 surpass, potentially see a retest at the current all-time high area, 6,930, that was printed previously on the 29th and 30th of October this year. Only a bearish breakdown below 6,800 will negate this bullish bias view to see a deeper minor corrective pullback to retest the 20-day and the 50-day moving average, acting as a similar graphical support area at the 6,780, 6,760. Only a breakdown below 6,760 will see a deeper retracement towards 6,710 for the SPX 500. Lastly will be the Nasdaq 100 over here. So Nasdaq 100 yesterday, that sell off due to Microsoft news regarding about the AI sales quota reduction. But thereafter it denied it before, then it shaped a bounce. So where it bounced off right exactly at our first support level that we highlighted yesterday, 25,455, this green line here. So given that it hasn't surpassed our first resistance level at 25,760, we do not want to tighten my pivotal support to 25,455. So this will be my first intermediate support level to watch. Pivotal support zone still remains the same at 25,305. 25,185 for today. So as long as this 25,305, 25,185 short-term pivotal support holds, still maintain that bullish bias above 25,760, potentially take us up higher towards 26,070, which is the minor swing high area of 3rd and 4th of November, and confluence with a Fibo extension level of 1.382 on the ongoing bullish impulsive up move from the low of 21st of November. However, if we start to see a bullish break and hourly close above 25,760, then that I could tighten my pivotal support level towards 25,455 next. However, if we start to see a sudden bearish reversal and a breakdown below 25,185, then today's bullish bias view will be invalidated to see a deeper corrective pullback towards 24,920 again. So 24,920 is also very important level. Why? Because that also confluence with the dotted gray line here, which is the former descending trend line resistance taken from the current all-time high of 30th of October, where the bulls got rejected on 12th of November, and now turns into a critical short-term pullback support level at 24,920. So that sum up all the intraday technical outlook on the major stock indices. Next up will be the commodities market. Gold, rather boring. So gold XAU/USD going to trade in a sideways fashion, holding above our pivotal support level that we have yesterday, 4,150. But can't surpass above our first resistance at 4,267 that was almost met on Monday. So still no change. Watching the 4,150 level very closely, because that also confirms very closely to the rising 20-day moving average. Still maintain that bullish bias, but first resistance level to watch still remains the same at 4,267. Only a bullish breakout above 4,267 will increase the odds of a further recovery towards 4,310 next, which is the minor congestion area of 21st of October and the one-time Fibo extension taken from the low of 28th of October very closely. However, a bearish breakdown below 4,150 will invalidate today's bullish bias view to see a deeper minor corrective pullback unfolding towards the next two support level to watch, 4,105, followed by 4,038, which is a very key short-term support level. Why? Because the we call it the bulls, the bears managed to get stopped during 20th of November and 24th of November, where it traded sideways before this last leg of minor bullish impulsive up move sequence take hold. So that's for gold XAU/USD. Lastly will be the West Texas oil. So West Texas oil also traded sideways below the 50-day moving average, which was yesterday's pivotal resistance zone at 60.10, 60.40. So still no change, still maintain that bearish bias below 60.10, 60.40, short-term pivotal resistance zone. First support level to watch will be Tuesday US session low at 58.35. That also confluence with the low on Monday Asia session. Only a bearish breakdown below 58.35 may see further weakness to retest the swing low of 21st of November and 25th of November at 57.54/57.31. Only a bullish breakout above 60.40 will negate this bearish bias view to see a squeeze out back towards 61.30, 61.70 next, which is the minor swing high area of 3rd of November and 12th of November, and this gray descending trend line resistance taken from the high of 31st of July this year. All right, so that's West Texas oil, and also sum up all the intraday technical outlook on the broad-based cross asset classes that we cover on a frequent basis. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So today will be a Thursday over here. So over at Thursday during the European session over here, there is not much key data to look out for except for Eurozone retail sales figure up at 6 p.m. Singapore time, year on year for the month of October. Market is expecting a further uplift to 1.4% year on year from the previous print of 1% in September. So if it came in with expectation or better than expectation, that could potentially reduce the odds of further ECB rate cuts going forward into Q1 this year. That could further support the firmer up move on the euro dollar that has taken shape since 2 weeks ago. Right, so that's for the Eurozone retail sales figure for October up at 6 p.m. Singapore time. Then thereafter, we do have a couple of ECB officials speaking. 9 p.m. Singapore time, ECB support will be speaking, followed by 11 p.m. Singapore time, ECB Lane will be speaking over here. Then thereafter, it will be a rather quiet US session. So right now, I don't think the US officials are allowed to speak pertaining to monetary policy because it's a more of a blackout period. They can still speak, but on other topic. So Fed Bowman will be speaking at 1 a.m. Singapore time, early Friday, but I don't think she will be able to mention anything regarding monetary policy. Then at 2 a.m. Singapore time, another ECB official speaking, ECB Gundos will be speaking over here. And before the start of our daily dose at 11 a.m. tomorrow, Friday, 5th of November, there are a couple of key Japanese data that we should take note of that could influence the movement of the dollar-yen, the yen crosses, and even the Japan 225 CFD index. Firstly, coming out at 7:30 a.m. Singapore time, we have household spending for the month of October. And after that, that's 7:30 a.m. household spending. Then thereafter, no other Japanese data, because the next Japanese data, the coincident index and the leading economy index will be updated at 1 p.m. Singapore time tomorrow. So with that, that sum up today's daily dose of market insights. Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.